Hey everybody, this is Brant from Wolf on Wall Street Trade with the market update for the week ending May 29th, 2020. Today's May 30th. It's my birthday. I turn 39 again. And thank you for all the notes. I did not do a video last weekend. The reason why was it was Memorial Day and there really wasn't anything going on the prior week. We'll get to that in a minute. As of the last video that I did do 2 weeks ago, the market was getting kind of dicey. This is IWM on a 60-minute chart, small caps. They were breaking down below this trend line here, which looks like a big flag. I'm not sure if it is or not, but it looks like a big flag. So the point was getting a little bit dicey. And then the following Monday, we got this big gap up over here, a big short squeeze too. And this was on reopening hopes. You know, the U.S. economy is reopening and vaccine hopes. So a lot of those recently, a lot of vaccine hopes. This is a 5-minute chart of the S&P 500 rolled back to May 22nd, so the prior week. This would have been that Friday. So this was where things were getting dicey, and this is where we had a big gap up that Monday morning on vaccine hopes. That big gap up was almost all Sunday night and a little bit Monday morning, and this is Moderna in blue, and this was the reason why Moderna had some news about a vaccine that they were working on. There's like 100 different vaccines out there right now, so there's going to be a lot of this kind of news, but the market gapped up big on that. By the European close on Monday morning, which is right here, 11:30 a.m. Eastern Time, that was it for the week. There's 11:30 Monday morning. This is Friday. Absolutely no change on the week. So everything that was gained during that week was gained Sunday night to pre-market Monday morning, and then by the European close, that was it. Notice Moderna gave back all of those gains. So everybody talks about, how efficient the market is at discounting stuff. Well, the market was up on this vaccine news, and then the vaccine news turned out not to be so hot. The market stayed there, but didn't give anything back. Dead flat on the week, so that's why I didn't do a video last week. Here's Moderna. Since that gap up, here's the big gap up on the big news. By the way, after the market closed on Monday, they sold a whole bunch more shares, secondary shares. But notice Moderna has given all of that back, actually down 30% from over here. Another issue is if they have a vaccine, then why are the insiders that work at the company selling so many of their shares? Here's Moderna's insider transactions. Here's that whole area we were just looking at. So $89 million in shares over the last year sold. And for the S&P's part, like I said, no change whatsoever. So really nothing to add. This week started the exact same way. I'm just going to walk this chart forward a little bit. That's the S&P 500. That is this past Monday morning. Same thing. Vaccine hopes. Notice all of the gains are from Sunday night to Monday's open. So outside of the cash session or in irregular hours, extended hours. Notice that the S&P 500 did capture this 3,000 area and its 200-day moving average, which is the same area, 3,001 and 71 cents, which it's been like 1% from for a week, 2 weeks, actually going back over a month. It's been really close to it. So it seemed like at some point that's just a magnetic force. It's going to have to tag that level. Did so on Monday morning, and this time it was a company called Novavax. So here's Novavax opening this Monday morning, and this is why the whole market was ramped up 18%. And let's just see what it did the rest of the week. Gave it all back again. The S&P, however, did not. So it did dip below this 200-day moving average in that 3,000 level a little bit earlier in the week, but managed to close at it and tested it Friday. Keep in mind also, this was month end. Friday was the very last day of the month. So there may have been some markup, for institutional purposes going on as well. There were a couple other interesting themes. One was this kind of giving up on the mega caps that have really led this rally, and another dash for trash. We saw one of these the very last week of April. So on IWM's chart, 30-minute chart, this is that last time we saw this big dash for trash. And why I say that was because the companies with the worst balance sheets rallied the most, and the companies with the best balance sheets either rallied the least or actually came down. So it was this rotation into the really cheap kind of stocks that are at risk because of the whole coronavirus or have, crappy balance sheets. So that included energy companies, airlines, financial firms, and small caps. So the exact same thing that happened at the very end of April. This is the very end of April. This is the start of May. Happened this past week, this kind of dash for trash. You may remember that I was talking about, as it started over here, one of the best performing companies For small caps, one of the best performing small caps that had, gained the most was Hertz. Here's Hertz. This is the rally I'm talking about. It was huge when you looked at it, at the time. You can see what's happened since because they went bankrupt. But this was one of those stocks that led that kind of rally. Here's American Airlines, another one at the end of April. Led the rally. The airlines, not just American Airlines. This past week, again, what happened? Same thing. The cruise lines. Here's Carnival. End of April. There's that rally. And here it is this week. And as mentioned, the banks. This is the KBW Bank Index. Here it is at the end of April. And then broke down. This is part of the reason why, like I was saying a couple weeks ago, the market ended in a really ugly place. The banks were one of the reasons why. So the banks were one of the ones bid this week. So the kind of theme was letting go of these secular growth stocks, which have been the favorite, which are basically the mega caps, Facebook, Amazon, Apple, Google, Microsoft. And then jumping into these riskier stocks that have been beaten down. So the cruise lines, the airlines, the banks. This actually worked out pretty good for me because there was a bank I was looking to sell short, if it could rally enough. So this week gave me that opportunity, and I did that Friday afternoon. On the week, S&P 500 up 3%. Remember, I was talking about this really kind of lateral range that we've been seeing for well over a month, 6 weeks over there. So kind of broke out of that. Notice the S&P 500 captured its 200-day moving average and defended it even Friday. So 3% on the week for the S&P 500. IWM, 3% for the week. Here's the week. It broke out above this little range. Now, 3%, pretty good. Remember I said dash for trash, small caps were one of the leaders. It gave back an earlier gain of 7%, more than 7% on the week. So we'll look at that more closely in a moment. And NASDAQ 100, 1.5% on the week, meaning it's the laggard. So you can see how it started out the week, pretty rough shape. So that 1.5% gain was all Friday alone. So this kind of dynamic that started early in the week, the dash for trash and kind of giving up on those mega caps, reversed at the end of the week on Friday. And the week before, we had seen some negative divergences in QQQ. As a matter of fact, if you didn't see my video last week, which you didn't because I didn't make one, I actually did put out a free post on Monday night, which was before the week opened. A lot of times I'll do that. If I don't do a video, check the website. I'll have a public free post. So one of the things we saw was NASDAQ and these mega caps running into resistance or seeing some distribution. And that was coming into this week. NASDAQ looked the worst on 3C charts coming into the week. Dow looked the best. The Dow did the best on the week, 3.25%. So not only did it kind of get above this 24,000, 24,500 level. This is the week over here. It got above 25,000. So it was the best performer on the week. But there's something interesting to note. And we'll go to a 60-minute chart so I can show you. This is this week. Ironically, this forms a broadening formation in the Dow. We've seen these before. So a broadening formation is higher highs. That's bullish, okay? Higher highs are bullish. But to be a bullish trend, you also need higher lows. And that is what we do not see in the Dow. We have lower lows. What this is a broadening formation. If I add some trend lines, you can see it. It's a broadening formation. This was the dicey area I was talking about as of the last video, and that is the lower low. But it's not just the Dow. So what did I say worked this week? The dash for trash, that included the airlines, the cruise lines, the transports. Here's the Dow transports over the same period. You see the same thing. Higher highs, lower lows, broadening formation. The financials, what do they have? Same thing. It's psychologically, it's telling you the same thing, that there is chaos over here. That is what a broadening formation represents. It represents a market that's kind of lost its way. It's lost intelligent sponsorship, and it's being whipped around by wild rumors and news. For instance, going back to the Dow chart, over here, Gilead's remdesivir. Over here, Moderna. And over here, Novavax. We saw what happened to all those stocks. They gave back all those gains. The market didn't. So the market is not an efficient discounter like everybody says. Where else have we seen big broadening tops? For 2 years on this 2-day chart of the Dow. Again, higher highs, right? Higher highs and lower lows. What this represents is chaos. Now, one other interesting thing to point out about the month of May. Again, here's the S&P 500 on a 30-minute chart. And we had this very lateral kind of range. Earnings season too, a lot of times you see that during earnings season. This is why I stayed away from options in here and expressed my positions differently just because I didn't want to get chewed up, through time, through a sideways market like this. But the month of May has seen the S&P gain 134 points from the time the market closes until the time the market opens. Or said another way, in the overnight session, it's gained 134 points for the month of May cumulatively. During the cash hour sessions, okay, from 9:30 Eastern to 4 o'clock, it has lost 22 points. That means all of the gains for the month of May were made in the overnight session or the weekend session outside of normal cash hours. And in the cash session, you don't see any follow through. You actually see the market lose points. So here's a chart of the absolute performance. The red line is the overnight session gains. The green line is the cash session. And what do you notice? About mid-month, right when I said it got dicey, IWM started to break down, all of the gains since then have been in the overnight session. No follow through in the cash session because it's actually below the zero line, so losing money in the cash session. Now, why does that matter? Stocks gap up, things happen in the overnight session. There's nothing wrong with that, but the entire month's gains being made in that very light overnight session, very light volume. Let me show you what I mean by that. Well, it's suspect. So this is the month of May. This is S&P futures. The black area is the cash session, and the kind of shaded gray area, that's the overnight session or after hours, extended hours. Down here is volume. There's absolutely no volume in the overnight session. Big volume over here is the cash session. That's where professionals transact because they transact in size. So if you want to move the market, what's the easiest way to do it? To spend the least amount of money. You do it in the overnight session where it takes no money really, no volume to move it. And that is what we've seen the whole month of May. And particularly the back half. So here's May 15th. Here's the overnight session gains as opposed to the cash session gains. This is probably also why we're seeing really weak 3C signals. I have no problem if the market gaps up, but it's got to show some follow through in the cash session where the professionals are transacting. So here's a 3C chart of the SPY. Okay, and you can see the dates down here, April, and here's where May starts. So we get a small negative divergence into the end of April, little positive divergence over here to start into May. Look at the negative divergence over here. Prices eventually come down, get a short squeeze and, a positive divergence again. Here we come into the end of the May, the last half of May. Overall, look at this big negative divergence. That's because the market has been moved entirely in the overnight session where there's no volume, and we're not seeing that follow through buying in the cash session showing up on these 3C charts, which is giving us this big negative divergence as we get deeper and deeper into the end of the month of May. Same thing with the Dow. Here we are in the end of April, again being ramped up here on remdesivir rumors. Negative divergence, prices come down. Again, not a huge negative divergence, but enough, prices come down. Here is the end or the second half of May, the last 2 weeks of May. No confirmation there, and that's what I would expect to see, knowing what I know now about what has transpired as far as moving the market in overnight hours only. This looks like an increasing pattern of distribution, meaning sell into higher prices. Another interesting thing about this week, and maybe, keep in mind that we did have this kind of dust up with China, and that kind of came to the forefront at the end of the week. But another interesting thing is I've been talking about the defensive sectors, okay, the sectors that are bond proxies. This is a 60-minute chart of consumer staples. Out of all the sectors that I see, these have had the most bullish consolidations. It looks like a big bullish flag, right? So what happened this past week with these defensive sectors? Let's walk it forward. Breakout there in consumer staples, a breakout here in utilities, and this was among the best performing sectors on the week. Didn't get a lot of attention for that. And while this wasn't my favorite because it had broken down a little bit, the real estate sector. So again, another bullish consolidation and a breakout this past week. So you have the three defensive sectors breaking out this past week. Another point of interest, last week I pointed out to members, to subscribers, this is the healthcare sector, 3C chart. I pointed out there looked like there was accumulation here going on last week, coming into this week. Looks like we got like a little head fake over here. This is not a defensive sector. It's not like a bond proxy, but it is defensively oriented. and it has been consolidating in a bullish consolidation for 4 or 5 weeks, just like those other defensive sectors. Here is where we saw that kind of accumulation, breaks out this week as well. So defensive sectors breaking out, that's an interesting rotational shift that I think a lot of people didn't pick up on. They picked up on, oh, look, the junky stuff is working. People are getting excited about, the reopening. But at the same time, you have the most defensive sectors acting the best on the week. One other interesting point is VIX. So VIX was only down 2.3% on the week. Not bad at all. And notice over here, mid-May, where we had that kind of trouble, that dust up, VIX has not traded below that level in the last 2 weeks, even though the S&P, all the other major averages have made higher highs. So that's relative strength in VIX. If I throw some trend lines on here, you can see this big pullback while the market's been rallying. Looks like it may be getting ready to break out. Now, on the other side of that, VVIX was very weak this week. It really did look like there was a big change in character, and this past 2 weeks just hammered down to a new lower low. So that is something, a disconnect I really can't explain. I did see volatility's term structure acting a lot better than it should, considering what the averages were doing, meaning looking more defensive, looking like people were hedging. And then also VIX futures and VXX on 3C charts were acting a lot better this week. So positive divergence most of this week in VXX. And the last time we saw one of those was over here right before it made this run. Also notice VVIX should be trading at a new low relative to where it was over here in mid-May. So also relative strength there. This is the dollar yuan, and this is something I pointed out a couple weeks ago as well. It was looking more and more risky. So this ramp up here, this is not good for risk assets. This is the yuan selling off. This is the March low, the market's crash low. This is where the yuan was. This pullback over here of about 1, 2, 3, 4, 5, 6 weeks or so, this is while the market rallied. So several weeks ago, it broke out, starting to show some risk on the horizon, specifically tied to U.S.-China relations. This was not on the equity market's radar at all, and even coming into this past week, really was not on the equity market's radar. And that was one of the things in that brief that I did Monday night in lieu of the video, to say be on the lookout for that this week. So this was a pretty big move this week. The yuan selling off, nearly breaking out above the 720 level. That means the yuan, relative to where it was over here, is even lower than at the March crash. In other words, it's reflecting major risk. There's a fairly easy way to kind of put it into context, but unfortunately, this platform, Thinkorswim, does not have any of the data for USDCNH as of the end of March. This is it in purple. This is S&P futures over here in red and green candlesticks. This is the crash low. This is the bounce or the rally, the kind of trend rally since. But what I'm going to do is back this up and just show you the relationship. So this is backed up a little bit. Again, S&P futures in the red and green candlesticks. The USDCNH inverted in purple. So this is kind of from the yuan's perspective. Purple line is the yuan rallying. This is October of 2019. So here you can see inline, rallying, everything looks fine. We get a negative divergence here. In the currency pair, the market pulls back. This is the end of January. So the market's rallying, the yuan's rallying. It reflects risk right here, real quick. This is the coronavirus exploding in China. The S&P pulls back about 3%, and that's it. Okay, the S&P goes on to rally to all-time new record highs. Watch what the yuan does. S&P rallies to record new highs. The yuan keeps diverging. It is saying risk, risk, risk. Everybody says the equity market is so great at discounting the future. It isn't. It used to be. I think the Fed has completely screwed up the equity market, the market signals. The currency pair here was doing a fantastic job because the Fed doesn't manipulate it, right? But the equity market didn't see the risk that was right in front of its nose until it crashed, okay? So instead of pricing in risk as the currency pair saw, ignored it, made new highs, and then priced it all in at once, and this is what it looked like. So the two went down together. Here you can see is the crash low, and this is where the data ends. The yuan right now would be sitting down here below the crash lows in March. That is the kind of risk it's reflecting right now. Here's kind of a screwball attempt of me trying to do it. This is the yuan reflecting that risk before the markets crash. This is the S&P crashing. Okay, here's the rally since. This is the yuan reflecting that risk. especially the last couple weeks, when it broke down below this level over here. So this is what I'm saying. It's already below the March crash levels. That's the kind of risk it's reflecting. Jumping back to the S&P 500 on the week again, 5-minute chart, here's the week. It did pick up on that risk Thursday as it became known that President Trump was going to hold a press conference Friday. So you saw the market sell off. Here's the press conference Friday. Remember, this is the 3,000 level and also the 200-day moving average. So the S&P kind of bounced along that, held that, and then the market figured out, well, President Trump, said some things, but he really didn't say as much as the market feared he was going to say, like we're going to pull out of the phase one trade deal or anything like that. So the market did rally into the close, okay? Wasn't as concerned. But what is interesting is the bond market did the exact opposite. The bond market saw risk and it rallied, which sent yields lower. Here's the press conference, sent them to the lows of the day, and not only the lows of the day. Remember, the bond market has not been on board with this rally the entire time. This is the 5-year yield, by the way, a 60-minute chart. It also was warning in February and in January that there was major risk ahead while the stock market was doing this and going up, right? So here's where the market's rallied from the March low. Stock market's gone like this. It has been creeping down to lower lows. It has not. This is not what you see at a market bottom. You see yields take off to the upside, even lead the market to the upside. But the last couple of weeks, they've been consolidating. This is Friday, so did break down on Friday, a very different reaction than what stocks had. Here's a closer look. Again, the last couple weeks, not really reflecting a lot of risk. There's a lot of noise, but not reflecting a lot of risk until Friday over here, breaking this trend line. So what I've been telling my subscribers is I think if this 5-year trades under 0.3%, I think it's really like risk off at that point. So interesting dichotomy. Stocks took it one way at the end of Friday, said, no big deal here, and bonds took it the other way. Maybe looking forward to the weekend or Sunday when markets open and China has some reaction to what the president said on Friday. Who knows? Interesting on that. So one last thing I want to close with is just kind of the bigger picture, what I call the return to normal. And I'll show you why. I love this chart or this picture, this representation of mass psychology. It's kind of the emotional roller coaster of a bull market, a bear market, how things go. Okay, so you can see all the different emotions: media attention, enthusiasm, greed, delusion, the new paradigm, which means, it's different this time. That's the easiest way to say the new paradigm. And then the initial breakdown, denial of that, and return to normal. In my opinion, what we are at right now, we just went through the new paradigm at the end of 2019, early 2020. Here is the crash and then the return to normal. So if I could draw a trend line across this, which it's not scaled really well for, it might look something like this. This rally, the break of that trend line, and then the bounce back, the return to normal. And if you look at what the market has been rallying on, vaccine hopes, reopening hopes, it's that V-shaped recovery, the return to normal. We are going to return to a normal, but I think it's going to be a new normal, not the normal. So this is a monthly chart of the Dow. And you can see it goes all the way back to 1921. This is 1929. So each one of these bars is 1 month. I just have to do it this way because of this charting software. But what I want to point out is the new normal. If you look at that last chart I showed you, you'll see all those emotional stages that we go through. And let me add a trend line. This is the initial crash. And then this is a 5-month counter trend rally of 50% that backtests into that trend line. If you look at that past chart, that last chart I showed you, the emotional roller coaster, that is the return to normal. There's the crash. Here's the bounce back, the counter trend rally, the return to normal. And that's kind of where we are psychologically, mass psychologically. And this is why I bring it up. This is a weekly chart of the NYSE. This is 2003. This is the 2007 record high. This is the first break. This is the counter trend rally. Notice this trend line. Just like the Dow in 1929, you see the exact same thing play out back here in the financial crisis. And this is what happened after that. Now, the reason I mention it is because this week something interesting happened. Here's a weekly chart from the 2009 low. This is the 10-year bull market. Here is the recent crash. Here's the return to normal, right into that trend line. Just like 1929, just like the financial crisis. It's in NYSE right here, and this is the IWM, or small caps. Same thing. Crash right through it. This is a weekly chart. Backtest right into that trend line. Remember I said small caps were up over 7% this week. They lost a lot of that. They ended up 3%, which is still respectable. But where did they really take a turn down? Right here at that trend line. Here's a closer look on a daily chart. Here is that turn down Thursday, right at that trend line. There's also another interesting area right here around 145. So here's a daily chart of IWM. Look at this overhead supply. And that is exactly where IWM turned down from this week, the exact same area as that diagonal trend line. I already have some short exposure in IWM. I added some short exposure the week prior to last in industrials, in a particular industrial. And then there was a bank that was acting really bad a couple weeks back, and I said, if it gets a decent bounce, I am going to sell that short as well. This is the KBW Bank Index, back tested into this broken trend line, and that gave me the opportunity I was looking for to sell short this bank. So I have some short exposure in small caps, I have some short exposure in an industrial stock, and in a bank because of what I saw here this week. As far as the financial sector, here's that last dash for trash. So this week it actually did break out. I thought that was pretty impressive, but it didn't hold it. Closed the week and right below it. So that was another reason I went ahead with that short in the bank, and the fact that yields had turned down as well. So with this whole new normal thing, I thought it was a really interesting set of occurrences on the charts this week, as well as what's going on in the country mass psychologically. Technical analysis does not tell you the future. A lot of people look at charts like it does. It does not tell you the future, but it does tell you a lot about probabilities. And there's a reason that we see this price pattern in 1929. We see it in some ways in 2000. We see it in the Great Financial Crisis, 2007, 2008 area. And we see it now. There's a reason for that. Every market is different, but human psychology is the same. It doesn't change over thousands and thousands of years. That's why Japanese candlestick charts that were originally used for selling rice hundreds of years ago work today. The psychology is the same. So I hope you enjoyed this video. Hope you forgive me for not having a video out last weekend. If you liked it, please give it a thumbs up. Feel free to leave questions or comments in that question comment section below. I do try to get to those. Check out the website. Again, there's free posts there. Last weekend I had the free post in lieu of the video, and you can check out subscribing, becoming a member. And on that note, I am going to go celebrate. Thanks a lot, everybody. Take care. Have a fantastic weekend.